Right now, across the country, restaurant foot traffic is just, it's plummeting.
Oh, absolutely.
I mean, if you look at the broader economic data, consumers are totally tapped out. They're skipping the drive-thru. They're canceling their Friday night dinner reservations.
Yeah, and you see fast food giants really panicking right now.
Right. They're rolling out these desperate value meals just to get bodies through the door.
Anything to drive traffic.
Exactly. People simply cannot afford to eat out the way they used to. And yet, amidst all of those empty tables, there's this 135-year-old food giant that is somehow selling 7% more food to those exact same struggling restaurants.
It sounds completely counterintuitive, doesn't it?
It really does.
It just defies the basic gravity of the current economic landscape. I mean, you have multi-year inflation headaches, you have fractured global supply chains, and a consumer base that is fiercely protecting its discretionary income.
Right.
And still, we're seeing certain legacy companies find this completely hidden gear of growth.
Which is exactly why we are jumping into this today. Welcome to another deep dive. Today, we are opening up the financial engine of Hormel Foods Corporation, ticker symbol HRL.
You're looking at a very specific snapshot today, too.
Yes, we are unpacking their Q2 2026 earnings call, which just took place on May 28, 2026.
And our mission today for you, the listener, is very specific. We are adopting a data-forward, investor-friendly framework.
No fluff.
Exactly, no fluff. We are going to look at the raw numbers, but more importantly, we're going to translate the dense Wall Street jargon from this earnings call into plain language. We want to understand the actual mechanics of how a business operates when the economy gets, choppy.
Because if you are listening to this and you hear the name Hormel, your brain probably goes straight to one of two places.
A can of Spam.
Right, Spam. Or maybe those cans of chili sitting in the back of your pantry. But when you actually read through this earnings transcript, you realize that is a massive underestimation of what they do.
It really is.
They are quietly operating an incredibly complex, highly diversified protein empire. I mean, we're talking about global exports, a massive retail grocery footprint, and an incredibly sophisticated food service operation.
Yeah, and to set the stage properly, we really have to anchor ourselves in the macroeconomic reality that Hormel's management team is navigating in the spring of 2026.
Which is not pretty.
No, it's not. Like we mentioned, the consumer is financially strained. Sentiment is demonstrably low. We are seeing a distinct polarization in how people spend money.
The barbell effect.
Exactly. But when you look at the raw scoreboard from Q2, Hormel isn't just surviving this environment. They're managing to pull off some genuinely surprising, highly strategic growth.
Let's start right there with the scoreboard, because before we can analyze the strategy, we have to know what the results were.
Right.
And honestly, these numbers are sizzling in an economy that feels remarkably chilly. So start us off with the top line. What did they bring in?
So on the top line, Hormel achieved its 6th consecutive quarter of organic net sales growth. Yeah. And for Q2 specifically, organic net sales were up 3%.
6 consecutive quarters. That is a year and a half of consistent top-line growth straight through some of the worst inflationary periods we've seen in recent memory.
It's impressive.
It really is. And then we look at the bottom line, right? The actual profit. Adjusted earnings per share, or UPS, hit 40 cents. That is a massive 14% increase versus the exact same quarter last year.
And this is where we need to put on our analytical hats, because how they achieve that 14% earnings growth is the real story here.
Yeah.
It was not just a matter of selling more raw volume of product. Gross profit was actually up 7%, and their gross margin expanded by 70 basis points, reaching 17.4%.
Okay, I have to stop you right there.
Okay.
Because 70 basis points of margin expansion is one of those phrases that gets thrown around on CNBC and people just nod along.
Right, like everyone knows exactly what that means.
Exactly. Let's break that down mechanically. First off, a basis point is just 1/100th of a percentage point. Right. So 70 basis points basically means their profit margin increased by 0.7%. Now, to an everyday person, 0.7% sounds like a rounding error.
It sounds tiny.
Right. But in the modern food industry, where margins are notoriously razor thin to begin with, that kind of expansion is massive. I like to think of it like a casino slightly tweaking the odds on a roulette wheel in their favor.
That's a great analogy.
Yeah, like the individual gambler, or in this case, the grocery shopper, doesn't really notice the 10-cent difference on a pack of bacon. But over millions of daily transactions across thousands of supermarkets, the house takes home significantly more cash.
Absolutely.
So my question is, how exactly did they tilt the odds? How do you expand margins when shoppers are allegedly pinching every single penny?
It's a great question, and it really comes down to two very deliberate mechanical levers.
Okay.
The first lever is the sheer physics of how retail pricing works. This margin expansion was the result of a perfectly timed second wave of pricing actions that was actually initiated months prior.
Wait, walk me through the timeline of that. How does a pricing wave actually work in practice? Are they just calling up Walmart and saying, hey, turkey's more expensive today, change the price tags?
Not at all. It is a highly bureaucratic, heavily negotiated process.
I can imagine.
Yeah. So when commodity costs rise, let's say the cost of corn and soybeans to feed turkeys skyrockets, Hormel's cost to produce a pound of meat goes up immediately.
Right.
But they cannot just unilaterally change the retail price on the grocery store shelf the next morning. They have to go to their retail partners, the Krogers, the Walmarts, the Targets of the world, and justify a price increase.
And those retailers are going to fight back tooth and nail, right? Because they want to advertise the lowest prices to their own shoppers.
Exactly. So there is a tense negotiation period. Hormel announced this specific second wave of pricing actions at the end of fiscal 2025.
Okay.
Once the retailer agrees, it takes roughly 90 days for that new pricing architecture to actually flow through the supply chain, hit the store shelves, and begin reflecting in Hormel's incoming revenue. So what we saw in Q2 of 2026 was the quarter where that 90-day lag time finally expired. The new higher prices went into effect, and Hormel finally reaped the mathematical benefit of those intense negotiations.
Okay, so the prices went up, and surprisingly, the consumers absorbed it instead of just walking away. But you mentioned a second lever.
Yes, and this second lever is perhaps even more vital to their long-term health. Management refers to it as favorable mix.
Now that is interesting. Favorable mix. Are we talking about the actual ratio of what people are tossing into their shopping carts?
Precisely. You would assume that in a tight economy, everyone retreats to the cheapest possible calories.
Right, yeah, absolutely.
But that is not what the scanner data showed. Hormel saw consumers actively buying higher margin premium items within their portfolio. We were talking about double-digit growth in Genio ground turkey.
Oh, wow.
Yeah, and we're seeing incredibly strong sales in Black Label bacon. They also noted significant momentum with Applegate frozen breaded chicken and their premium breakfast sausages.
So mechanically, if a shopper buys a premium package of Applegate organic chicken instead of a baseline commoditized product, Hormel makes a slightly higher percentage of profit on that specific transaction.
Yes.
And then when millions of shoppers make that choice, your overall corporate profit margin expands.
That is the math. You combine strategic delayed price increases with a consumer base that is still reaching for premium bacon, and suddenly your margins beat Wall Street's expectations.
That makes perfect sense.
And naturally, the cash flow follows suit. They reported a very healthy $179 million in cash flow from operations for the quarter.
Which gave them the liquidity to do something that absolutely blew my mind when I read the transcript. They returned $161 million to stockholders in the form of dividends.
Huge number.
Huge. And management casually noted that this was their 391st consecutive quarterly payout.
It is a staggering statistic. I mean, if you divide 391 quarters by 4, you are looking at nearly 98 years.
That is almost a century of uninterrupted quarterly dividends.
It really puts it into perspective.
It does. That spans the Great Depression, World War II, the stagflation of the 1970s, the 2008 financial crisis, the pandemic. Through all of that, they never missed a quarterly payment.
Yeah.
That speaks to a level of structural operational resilience that you almost never see in modern publicly traded companies. And they aren't just paying out all their cash either. Their cash on hand swelled to $827 million.
Which is an increase of $156 million just since the end of the previous fiscal year.
Unbelievable.
When you view these headline numbers in totality, you know, the EPS beat, the 70 basis point margin expansion, the massive growing pile of cash, it paints a picture of formidable financial health.
Right.
But as we know, enterprise numbers only tell us what happened at the highest level. To extract actionable insights, we have to dissect the income statement segment by segment. We need to see exactly where this growth is originating.
And this is where we have to address the contradiction I brought up in the very first minute of this deep dive. Let's talk about the food service segment.
Yes, let's get into it.
Because according to the transcript, food service organic net sales grew by 7% and segment profit jumped 11%.
Significant number.
Very significant.
Yeah.
The key brands driving this were Natural Choice, Austin Blues, Genio, and Fontanini. But again, I have to challenge this premise. Restaurant traffic is broadly, demonstrably down. Fast food, fast casual, independent sit-down joints, foot traffic is bleeding out.
It is.
So I need you to explain the mechanics of this. How on earth is Hormel selling 7% more food and making 11% more profit, selling to restaurants that have fewer customers walking through the front door?
It is the ultimate puzzle of this earnings call, and the answer lies in understanding how Hormel actually interfaces with these restaurants. Hormel does not just back a refrigerated truck up to a diner and drop off boxes of raw meat.
Okay.
They employ a massive, highly trained direct sales force. These salespeople essentially act as operational consultants and problem solvers for restaurant owners.
So they aren't just order takers flipping through a catalog.
Not at all. Put yourself in the shoes of an independent restaurant owner today. Aside from declining foot traffic, what is the single biggest existential threat to your business?
Oh, it has to be labor. Finding reliable line cooks, paying them a wage they can actually live on, dealing with turnover.
Exactly. Labor is crippling the hospitality industry right now. An owner simply cannot find prep cooks, or they cannot afford the $20 an hour wage required to keep them. So Hormel's sales force steps into that kitchen and offers a solution that management calls kitchen shortcuts.
Kitchen shortcuts. Okay, walk me through a specific example of how a shortcut replaces a prep cook.
Let's use the Austin Blues brand as the perfect case study.
Okay.
Imagine a mid-sized local restaurant wants to put a BBQ pulled pork sandwich on their menu. If they do it from scratch, they have to buy raw pork shoulders, they have to pay a cook to trim the fat, apply a dry rub, load it into a commercial smoker, monitor the temperature for 12 hours, pull it out, shred it by hand, and portion it. That requires massive amounts of expensive labor. It requires specialized equipment, it carries the risk of food waste if the cook brains a batch, and it invites scrutiny from local health inspectors regarding raw meat handling.
That is a massive logistical headache just to sell a sandwich.
Exactly. So the Hormel rep walks in and says, hey, instead of doing all that, buy our Austin Blues fully cooked, fire-braised pulled pork. We smoked it for you over real hardwood in our massive, highly efficient, centralized facilities.
Wow.
Yeah, all you have to do is open the bag, heat it up, and serve it.
I see. Hormel is effectively absorbing the labor cost into their product. They're doing the hard work at scale, and the restaurant is more than happy to pay a premium price per pound for that meat because it allows them to fire their prep cook or at least run a much leaner kitchen staff.
Precisely. So even if that specific restaurant has 10% fewer customers walking through the door this month, they might increase their dollar order from Hormel by 20% because they have shifted all of their back-of-house preparation work onto Hormel's supply chain.
That's brilliant.
Yeah, Hormel is capturing a much larger share of the restaurant's total operational spend.
That makes perfect sense.
Yeah.
The logic there is absolutely bulletproof. You shift the labor, you capture the margin, but it goes beyond just saving labor, right? Because the transcript also talked heavily about menu innovation.
Yes. A restaurant can't just cut costs. They have to give diners a compelling reason to get off the couch and come eat.
True.
And Hormel's direct sales force acts as an outsourced research and development team to spark that consumer traffic. A great example from the call was the International Pizza Expo. Hormel utilized that event to launch new Calabrian chili pizza toppings across both their pepperoni and sausage lines.
And why Calabrian chili specifically? What is the strategy behind a localized, trendy ingredient like that?
Think about the economics of an independent pizzeria. Pepperoni is already a massive volume driver. Hormel is arguably the king of pepperoni.
Oh, for sure.
But local operators are getting squeezed by massive chains like Domino's who compete relentlessly on price. A local shop cannot win a race to the bottom on a $5 cheese pizza. They have to differentiate.
Right.
They need premium artisanal options on the menu to justify charging $25 for a pie. But a local shop owner doesn't have the time to source authentic Calabrian chilies and experiment with infusing them into sausage.
We just don't have the bandwidth.
Exactly.
Yeah.
Hormel does the R&D, manufactures it at scale, and gives the local pizzeria a plug-and-play, trendy, high-margin item.
It is so smart. They are an outsourced prep kitchen and an outsourced R&D department all rolled into one. And that completely explains how food service is growing despite a restaurant recession.
It really does.
Now, let's pivot, not just because it's the next section of the balance sheet, but because the logic of finding new markets and premium positioning leads directly into their international and retail segments. We cannot gloss over this.
Yeah.
International sales were up 5% and profit jumped an incredible 20%.
And that profitability metric is key. A 20% jump in profit internationally means they are highly efficient in those markets. The transcript highlighted localized strategies in China and the continued, almost unbelievable global demand for Spam.
Let's actually talk about Spam in China and the broader Asian market, because I feel like the average American listener views Spam through a very specific mid-century budget-friendly lens.
Oh, totally.
But internationally, it operates on a completely different psychological level.
It absolutely does. In many parts of Asia, Spam is not viewed as a desperation budget meal. It is integrated deeply into the cultural cuisine.
Right.
Think of budae jjigae or army stew in South Korea, or Spam musubi. In some markets, premium gift boxes of Spam are exchanged during Lunar New Year celebrations.
Half box.
Yes. Hormel recognizes this, and they don't just export American cans, they execute localized strategies, establishing dedicated supply chains and marketing campaigns tailored specifically to the palate and cultural positioning of the Chinese consumer.
That is how you drive a 20% profit jump. You treat the international market with premium respect.
Exactly.
That is fascinating. And looking domestically at the retail segment, organic sales were up 1%, but again, profit rose disproportionately, up 13%. The major anchor the CEO called out was double-digit dollar sales growth and actual market share gains in Genio ground turkey.
Which brings us back to the psychology of the modern consumer. Ground turkey sits at this incredibly unique intersection of affordability, versatility, and perceived health benefits.
Right. If you are looking at your grocery budget right now, you know inflation hurts. You might skip the expensive summer vacation, you might delay buying a new television, but you still have to put dinner on the table for your family. Protein is a dietary non-negotiable.
Exactly. And ground turkey is the ultimate utility protein. You can make tacos, meatballs, chili, burgers. It absorbs flavors well, and it generally prices out more attractively than premium ground beef.
I look at Hormel's retail success right now like a barbell strategy at the gym. On one side of the barbell, you have the heavy, reliable weight of the budget-conscious shopper. Hormel is capturing them with affordable, versatile Genio ground turkey.
Yep.
But on the exact opposite end of the barbell, they are simultaneously capturing the premium shopper. This is the family who used to go out to a nice restaurant, but to save money, they're treating themselves at home. So they splurge on Applegate organic frozen breaded chicken or premium Herdez marinades.
That is an incredibly accurate analogy. By holding strong market positions at both the extreme budget end and the extreme premium end of the pricing spectrum, Hormel is effectively insulating itself against the hollowing out of the middle class.
Oh, that makes sense.
Yeah, so many other consumer packaged goods companies who only make mid-tier products are getting absolutely crushed right now because their shoppers are trading down to store brands. Hormel captures the trade down, and they capture the stay-at-home splurge.
All right. We've talked about the margin expansion, the Calabrian chilies, the Spam gift boxes, and the barbell strategy. But to give a truly rigorous, balanced analysis of this earnings call, we have to look past the victories.
We do.
We need to examine the squeaky wheels. And management was remarkably transparent about the specific areas that dragged on their quarter.
They were. They explicitly admitted to facing structural pressures, and they missed internal expectations on two major heritage brands within their portfolio, Planters and Skippy.
Let's start with Planters.
Yeah.
The nut category is notoriously heavily influenced by raw commodity costs. The CEO noted that while peanuts are performing just fine, consumers are aggressively trading out of high-priced nuts, specifically pointing the finger at cashews.
Yes.
Now, I have a hypothesis here. Are they just leaning on cashew farmers globally to take a haircut on their prices? Or is Hormel just forced to eat the margin loss?
Neither, actually. It comes down to the stark realities of global commodity inflation. There has been significant inflation on raw cashews over the past year. You cannot simply bully a global commodity market into lowering prices. When Hormel's cost to buy raw cashews goes up, they are forced to raise the retail price of a jar of Planters cashews to protect their own profit margins.
Right.
But there is a psychological ceiling to what a consumer will pay for a mid-afternoon snack. When a jar of cashews suddenly hits $8 or $9 on the shelf, the shopper looks at it, experiences sticker shock, looks at the $4 jar of peanuts sitting directly adjacent to it, and simply trades down.
So the volume of cashews sold just plummets. How do you fix that? Because as you said, you can't magically make raw cashews cheaper globally.
This is where we get into the hidden mechanics of the grocery store. You fix it by utilizing what the industry calls revenue growth management, or RGM.
RGM.
Right. Hormel noted they are deploying strict RGM tactics, which involves designing entirely new pack size strategies.
Wait, RGM, is that just the polite corporate Wall Street term for shrinkflation? Because I have definitely noticed that my jars of snacks seem to be getting a bit slimmer lately.
In a mechanical sense, yes, shrinkflation is a component of revenue growth management. But RGM is highly data-driven. Let's walk through the logistics of how this works on a factory floor.
Sure.
Let's say Hormel's data algorithms determine that the absolute psychological barrier for a consumer buying cashews is $6. If it goes to $6.01, sales drop by 40%.
Wow. Okay.
But due to commodity inflation, Hormel can no longer afford to put 16 ounces of cashews in a jar and sell it for $6 without losing money.
So you have to re-engineer the product to hit the price target.
Exactly. They literally go into the factory, retool the manufacturing lines, change the plastic injection molds for the containers, and redesign the jar to hold, say, 14.5 ounces.
Nikki.
It looks incredibly similar on the shelf, but it holds slightly less product. That allows Hormel to hit that critical $6 price point profitably. You essentially hide the global commodity inflation within the physical architecture of the packaging.
It is a ruthless game of millimeters on the grocery shelf. You shave off 1.5 ounces just to protect the psychological comfort of the shopper.
And you combine that packaging redesign with heavily investing in lower funnel digital and e-commerce advertising. You target shoppers on grocery delivery apps right when they're checking out, trying to capture impulse buys. That is how you slowly rebuild the volume in a troubled commodity category like cashews.
Okay, so revenue growth management and new packaging is the fix for planters.
Mm-hmm.
What about Skippy? Because the peanut butter aisle is a bloodbath of competition. You have Jif, you have Peter Pan, you have Justin's, you have the store brands. What went wrong with Skippy?
Skippy experienced a very soft first half of the fiscal year, but unlike the cashew situation, the root cause here was highly specific and localized.
Okay.
Late last year, Hormel suffered a fire at their Little Rock manufacturing facility.
A literal fire.
A literal physical fire that disrupted production. Now, to management's credit, they restored their supply chain very quickly, but in the immediate, uncertain aftermath of that fire, management had to make a very conservative, difficult choice.
What was that?
Well, to ensure that they did not short their retail partners, meaning to ensure Walmart didn't end up with empty shelves where Skippy was supposed to be, Hormel pulled all of their planned first half promotions.
Meaning they went dark on the marketing side?
Completely dark. They stopped running digital sales. They canceled their end cap physical displays in the stores. They halted the coupon distribution.
Oh, wow.
Yeah, they wanted to suppress consumer demand slightly so they wouldn't run out of whatever inventory they had left. But when you go dark in a highly commoditized, fiercely competitive category like peanut butter, the consequences are immediate.
I can imagine. If I walk down the aisle and the Skippy doesn't have a yellow sale tag on it, but the Jif does, I just grab the Jif.
Exactly. Consumers are brand loyal to a point, but they are also price sensitive. If you aren't promoting, you lose what the industry calls shelf memory.
Shelf memory.
Yeah, shoppers literally forget your brand is their default choice because they spent 3 months buying whatever was discounted that week.
That is a dangerous position for a legacy brand.
Mm-hmm.
How do you recover that lost shelf memory?
You turn the promotional lights back on aggressively. The transcript noted that the back half of 2026 is heavily loaded with Skippy promotions. And we are already seeing the mathematical result of that. Management explicitly pointed out that the latest 4-week consumption data from Circana is already showing a significant rebound.
Let's clarify that for the audience, because Circana sounds like a pharmaceutical drug.
Yeah.
Circana is essentially a massive market research firm, sort of like the Nielsen ratings, but for grocery store cash registers. They track exactly what is being scanned at checkouts globally.
Precisely. And the Circana scanner data proves that once Hormel put the coupons and the end cap displays back in front of the consumer, the volume immediately returned.
Okay, so let's tie this together. Executing massive nationwide promotional campaigns for Skippy and physically redesigning and manufacturing new cashew packaging for planters, all of this requires a flawless, incredibly well-funded supply chain.
It really does.
You cannot execute revenue growth management if your factories are a mess. And this brings us to what I think is the most fascinating section of this deep dive. We need to look at the massive long-term operational shifts Hormel is making, because they are actively trimming the fat from this 135-year-old company.
The biggest, most consequential headline here is that Hormel fully divested its whole bird turkey business.
I read that and I had to read it twice. They sold off the whole bird business. That sounds like absolute heresy for a company that owns the Genio brand.
Right.
The Thanksgiving turkey is practically an American institution, and management openly admitted this divestiture caused a $50 million reduction in their fiscal 2026 net sales. They took a massive top-line hit, and it resulted in a recorded loss on the SG&A line.
It did. But if we analyze the underlying logic, it is an absolutely brilliant strategic move.
I need you to convince me of that. Why would you willingly surrender $50 million in top-line revenue and take a loss on your SG&A? Which, by the way, stands for selling, general, and administrative expenses, basically the operational overhead costs. Why take that hit on your balance sheet?
Because selling whole raw turkeys, the frozen 20-pound birds you buy in November, is a pure, unadulterated commodity business.
Okay.
And commodity businesses are incredibly volatile and low margin. If an outbreak of highly pathogenic avian influenza or bird flu hits a major flock, your supply vanishes. If the price of corn and soybean meal on the Chicago Mercantile Exchange spikes, your cost to feed those turkeys skyrockets and your profit margins evaporate overnight.
And because it's just a raw, unbranded bird, you have zero pricing power. The consumer doesn't care whose logo's on the frozen turkey. They just buy the cheapest price per pound at Thanksgiving.
Exactly. You are at the absolute mercy of global commodity swings. By entirely ditching the whole bird business, Hormel neatly insulates its balance sheet from those wild, unpredictable price fluctuations.
This goes right back to the logic we saw with the restaurant labor. You get rid of the heavy lifting that doesn't yield a premium profit. They abandoned the volatile whole bird, but they kept the highly profitable, highly processed parts of the turkey.
Right. They are choosing to focus all of their capital and operational energy purely on value-added, branded turkey products. We are talking about the Genio ground turkey we discussed earlier, turkey bacon, sliced deli meat, pre-marinated tenderloins.
Oh, I see.
Yeah, in those specific categories, the brand equity actually matters to the consumer, and therefore, Hormel's pricing power is vastly stronger.
And the operational data from the quarter proves that strategy out. Management noted that the remaining vertically integrated turkey network operated beautifully this quarter, aided by favorable weather and excellent feed conversion rates.
It paid off.
It really did. Which leads me to a much bigger picture question. When I look at the totality of these moves, divesting raw commodity meats, leaning heavily into branded value-added products, utilizing complex data to execute shrinkflation on cashews, feels like Hormel is undergoing an evolutionary leap.
Definitely.
And then, right in the middle of the transcript, they dropped this piece of personnel news. Hormel just hired its first ever chief technology officer, a man named Don Monk.
It is a fascinating and highly revealing addition to the C-suite. Don Monk brings 35 years of global corporate experience, specifically with the track record of modernizing technology infrastructures at massive, complex organizations.
So my hypothesis here is this. With the divestiture of raw commodities and the creation of a CTO position filled by a heavy hitter, is Hormel subtly transitioning from a traditional legacy meat packer into a highly advanced, data-driven brand incubator?
Yeah.
I mean, what does a CTO actually do at a meat company?
It is a very astute observation. The modern food industry is no longer just about raising livestock and sealing meat in an aluminum can. It is fundamentally about data architecture.
Interesting.
It is about managing highly complex automated supply chains. It is about building predictive analytical models to forecast consumer trade-down trends before they even happen. Bringing in a dedicated CTO signals to Wall Street that Hormel realizes technology is the final frontier for margin expansion.
We are talking about artificial intelligence in the manufacturing process, predictive models for buying cashew contracts, and utilizing robotics in their distribution warehouses.
Exactly. Supply chain visibility. Knowing exactly where every ounce of product is and exactly what the optimal price point is for that product in real time. They are upgrading the software of this 135-year-old physical machine.
Which is something we definitely need to keep in mind as we look forward. Because management has laid out all of these operational shifts, they've explained the margin expansions. But what are they telling investors to expect for the rest of 2026? Let's analyze their forward-looking guidance.
Right. Management officially reaffirmed their full-year guidance. They are confidently projecting $12.2 billion to $12.5 billion in total net sales and $1.43 to $1.51 in adjusted earnings per share.
And the CEO specifically took the time to note that based on the current trajectory, they believe they are trending toward the upper half of that earnings range. That is a very bullish signal.
It is. However, and this is a massive caveat, they explicitly warned investors on the call that Q3 EPS would be basically flat year over year. They are intentionally tapping the brakes on Q3 expectations.
So mechanically, why are they doing that if they're crushing it so hard? 6 consecutive quarters of organic growth, 70 basis points of margin expansion, trending to the upper half of their full year guidance. Why are they warning everyone that Q3 is going to be stagnant?
It comes down to 4 distinct, highly quantifiable headwinds that are going to temporarily suppress Q3 profitability. We need to look at the mechanics of each one.
Let's do it. Headwind number 1, fuel costs.
Right. If you recall, geopolitical conflicts caused global fuel prices to spike midway through Q2. Because of the timing, Q2 only had to absorb about 6 weeks of those elevated fuel prices.
Okay.
Q3, however, is going to have to eat a full 13 weeks of those high transportation and diesel logistics costs. When you run a massive fleet of refrigerated trucks, diesel prices directly impact your bottom line.
That makes perfect mathematical sense. Headwind number 2, commodity volatility.
Despite shedding the volatile whole bird turkey business, Hormel still produces a massive, staggering amount of raw pork and beef for their other product lines. Management noted that beef and pork costs remain stubbornly elevated relative to their historical averages.
Right.
Now, there was a temporary deflationary dip in pork bellies recently, but the overall carcass cost is high. Management is choosing to model conservatively, assuming that second-half commodity costs will look a lot like last year's elevated, painful levels.
It is always smart to underpromise and overdeliver when it comes to predicting commodity markets. You don't want to get caught promising cheap beef if a shortage hits. Headwind number 3, a higher tax rate.
That one is simple enough accounting. Their effective tax rate is currently trending toward the upper end of their historical range, which simply takes a larger bite out of the final bottom line.
But it is the 4th headwind that I find the most actionable and honestly the most interesting because it ties directly back to that new CTO and the data modernization we discussed. Headwind number 4, inventory rebalancing. Unpack the mechanics of this for me. What exactly is happening here?
This is a textbook example of that operational modernization in action. Hormel is intentionally, voluntarily slowing down plant utilization for what they classify as ambient products.
And by ambient, we mean center of the store, canned goods, long shelf life items, things like Spam, chili, and Skippy peanut butter, items that do not require refrigeration.
Exactly. Thanks to their new integrated business planning systems, essentially, getting much better at analyzing their own internal data management, realized they were over-inventoried on these ambient products. They had too much finished products sitting in distribution warehouses.
So rather than keep running the factories at 100% capacity just to hit some arbitrary legacy production metric, they're choosing to dial back the production lines.
Yes, but there is a mathematical consequence to that. When you lower plant utilization, meaning you run a factory at 70% capacity instead of 100% capacity, your fixed costs, like the rent for the building, the electricity, and the salaried management, remain the same.
Right.
So those fixed costs are now spread over fewer units of production, which means your internal cost to produce a single can of chili goes up for that quarter, and your profit margin per unit drops. They are willingly taking a deliberate short-term margin hit in Q3 to burn off that excess warehouse inventory.
It is taking your medicine now so you can run a marathon later. They are sacrificing Q3 gross margins to eliminate warehouse carrying costs, ensuring they are running a highly efficient, much leaner operating model moving forward into Q4 and the next fiscal year.
Exactly. They are aggressively clearing the decks.
Which really brings all of these seemingly disparate threads together. We've talked about the intricacies of Calabrian chili toppings, saving labor in local pizzerias. We've discussed the psychological pricing thresholds of consumers trading down from cashews. We've covered a literal fire in a peanut butter factory, the strategic abandonment of the Thanksgiving turkey, and a new CTO rewiring the data infrastructure of a meatpacking empire.
It's been a lot of ground to cover.
It has. So if you are looking at your own portfolio or just trying to understand how massive businesses survive inflation, what is the core takeaway here?
The core takeaway, if you are analyzing this from an investor's perspective, is that while Q3 might look financially noisy or flat due to this deliberate inventory rebalancing, the elevated fuel costs and the higher tax rate, the underlying structural engine of this company is incredibly, remarkably healthy.
The truly bullish signal here isn't just about a company selling more hot dogs or bacon. It is about witnessing a masterclass in discipline management. It is about pricing discipline having the patience to negotiate and wait 90 days for a pricing wave to hit rather than panicking.
Absolutely.
It is about strategically shifting the consumer toward a premium mix of products.
Yeah.
And perhaps most impressively, it is about having a highly resilient, consultative food service sales team that can quite literally sell more food to restaurants during a nationwide traffic recession simply by solving their labor problems.
If you can look past the immediate Q3 roadblocks they mapped out, management is very clearly signaling to the market that their operational engine is primed for a massive double-digit earnings growth rebound in Q4. They have cleared out the excess ambient inventory, they have permanently divested the volatile, low-margin raw turkey business, and they have their promotional engines for brands like Skippy finally firing on all cylinders again.
It really is a fascinating blueprint for navigating a choppy, unpredictable economy. And that leads me to a final, somewhat provocative thought for you to ponder as we wrap up today. We started this deep dive analyzing the basic scoreboard of a food company. But as you watch a 135-year-old corporation hire a chief technology officer to modernize its supply chain, as you watch them utilize predictive data so perfectly that they know exactly when a shopper will decide that an $8 jar of cashews is too expensive and redesign the plastic mold to hide inflation, you have to deeply consider the future of the grocery store itself.
It is rapidly becoming less about the agricultural reality of food and vastly more about the invisible algorithms dictating how that food moves and is priced.
Exactly. Are we entering an era where the items sitting on your supermarket shelf, the exact fractional size of the packaging, and the fluctuating prices you pay for them are no longer just set by a regional manager with a pricing gun, but are dynamically, invisibly optimized in real time by artificial intelligence and predictive data analytics? Next time you're standing in the center aisle, reaching for a simple, unassuming jar of peanut butter, take a second to think about the immense, hidden, data-driven logistical engine that made sure it was sitting right there at the exact price point you were statistically willing to pay.
It certainly changes how you look at the items sitting in your pantry.
It really does. It is an algorithmic marvel hiding behind a familiar label. Thank you for joining us for another deep dive. We'll see you next time.